For more, let's bring in Kathy Bostjancic. She's Nationwide Mutual's chief economist, and Kevin Mahn, who is Hennion Walsh's president and CIO. He's on set with me. Welcome to you both. Kathy, let me just quickly start with you because I take Richard Fisher's point, but I think everybody would say the only thing the Fed cares about if a banking crisis is taking place or a credit crisis is fixing that too. So this one might be kind of on the back burner, but those data show it. It certainly hasn't gone away.
Yeah, happy to be with you, Kelly. Well, I think the large fallout from this is that even if we don't have a banking crisis, we're going to have tightening of lending standards. And that is going to have a meaningful impact on credit availability, as you indicated. And that acts as an additional brake on the economy. That, credit is the lubricant that keeps the economy running. So I think the Fed Reserve really doesn't know how much tighter conditions going to get now because of that. Before, as of Q1, 40% of the banks were already tightening lending standards for commercial industrial loans. That would have been indicative of a recession in the past, and it may still be that. And my guess will be the share of banks tightening lending standards goes up quite substantially. That said, inflation it does remain elevated and sticky. We look at the super core services number, which strips out housing, just below 6%. So it does look like, and the Fed's guiding us towards this, we're going to get one more rate hike. But my sense is they're going to pause for a long period of time to try to assess what's happening in the banking system.
Yeah, and even earnings, Kevin, are giving us some signals because we've had a bunch of guidance problems. Just to go through them a little bit, Procter & Gamble this morning, they only reaffirmed the full-year outlook. They only have a quarter left. Citi last week had that huge beat, but they only reaffirmed 2023. Chris Seneca at Wolf says of the 13 companies who have given guidance so far for next quarter, 9 of them have been below consensus. Disappointments are everyone from Carnival to Darden, Equifax, F5, Lam Research, Micron, Netflix, Philip Morris, and Seagate, which reported obviously that huge miss as well. So this so far, it's a little early still, but is telling us that the outlook even corporate America is giving, and usually they can't see that far ahead, is looking downbeat.
Absolutely, Kelly. And as it stands right now, according to FactSet, Q1 earnings for the S&P 500 are expected to contract by 6.5%. If that number holds true, it would mark the worst quarterly earnings since the second quarter of 2020 when the pandemic started.
Right.
So as we look at over 2 years, the investment opportunities start to jump out at us. Rates should be lower than, yields should be lower than, inflation should be lower than, markets should be higher. But over the course of the next 3 quarters, things are going to get choppy here as the economy continues to slow, earnings continue to get hit, and lending continues to be depressed.
So question, do you then start putting that list together and wait for lower entry points, or would you be doing anything right now?
Trying to time the market, as we know, is an exercise in futility. But I do believe if you start looking at those beaten up sectors, information technology, consumer discretionary, communication services, that really took a hit during 2022, well, they may look very attractive 2 years from now when the Fed ends. But until then, look at those more defensive sectors, staples, industrials, or even healthcare, those that pay a good dividend.
But they're expensive. I mean, so what you've summed up is exactly what's happened this year. We've seen people go back into tech.
Yes.
Now that's maybe running out of steam a little bit, and everything more defensive is already priced for that. So not a lot of people want to be piling in at maybe 25 times earnings if we think, again, like you said, I don't know when the right entry point is, but it's not a perfect sell at this point.
Let me give you a couple examples of what we like in those areas. Cummins, the large trucking supplier, pays a dividend around 2.6, only trading at a forward multiple of around 12 right now.
Wow.
Philip Morris, paying over 5.1%, is trading at a multiple of around 16. And then you look in the healthcare space. How about Merck, paying 2.6% dividend yield, only trading at a 16 multiple right now. So there are attractively valued, good dividend payers with strong balance sheets that should be able to hold up relatively well during a recession.